Lately, I've posted quite a few negative videos about Realty Income, and this has led some of you to label me as a hater. But the reality is that I don't have a dog in this race, I'm not shorting Realty Income, and I don't stand to benefit in any way by criticizing the company. On the contrary, I would probably make more money if I posted positive videos about the company, if that then convinced some shareholders of Realty Income to buy my REIT newsletter, Hired Landlord. But I'm simply trying to stay objective and share my independent thoughts on this YouTube channel, and if that leads some of you to think that I'm a hater, then so be it. I've actually owned a position in Realty Income for a few years. I've covered it for close to a decade. I've met quite a few of the executives in the past, as well as executives of their close peers. And yet last December, I decided to sell my position at around $57 per share due to some bad news that have recently come out, and that's what I'm going to discuss in today's video. Hey everyone, this is Yus. I run a small investment firm that specializes in REIT investing, and today I'm going to explain to you why I decided to finally get out of Realty Income. But before I get into it, I want to remind you that I plan to soon launch a Substack that will focus on REIT investing. There will be a lot of free research in there, so if that could interest you, feel free to check out the first link in the description of this video. So the first piece of bad news that's concerning me is that I think that the average portfolio quality of Realty Income has greatly deteriorated over the past years. Realty Income used to be perceived as a higher quality net lease REIT that will focus on safer, lower cap rate properties. They used to even have a slide in the investor deck that would explain how they were able to buy these higher quality, lower cap rate properties thanks to their cost of capital advantage, and how this would result in more consistent and predictable returns over time. However, those days are now behind, and as far as I know, they've even removed this slide from the investor deck. What happened here is that as Realty Income grew larger, single asset acquisitions were not really moving the needle anymore for them, and so they switched their focus to doing larger M&A deals that would rapidly boost their cash flow. They first acquired REIT, then they closed a major acquisition from CIM Real Estate, and then more recently they also acquired Spirit Realty Capital. These deals were highly accretive on day one and nicely boosted Realty Income's FFO per share because they were really large deals, so big volume, and on top of that they were earning a positive spread on them. But the cost of these deals is that I fear that they have massively reduced the average portfolio quality of Realty Income. REIT and Spirit Realty Capital both were considered to be lower quality net lease REITs. They both suffered major tenant difficulties throughout their existence, and that didn't stop Realty Income from acquiring them. As a result of this, if we now compare the portfolio characteristics of Realty Income to that of Agri Realty, which is its smaller peer that focuses on higher quality properties, we see quite clearly that Realty Income is today quite a bit inferior. It is more heavily exposed to riskier segments of the net lease market, it has lower exposure to investment grade rated tenants, has close to no ground leases, and so on and so on. But to be clear, this doesn't mean that these M&A deals were bad investments from Realty Income. I mean, as I said earlier, they nicely boosted their FFO per share. At the right price, any property can be a good investment, but the point that I'm trying to make here is that they have diluted the average portfolio quality of Realty Income. This increases risks going forward, and therefore I believe that Realty Income doesn't deserve to trade at the multiple of a higher quality net lease REIT anymore. Then the second piece of bad news is that I fear that Realty Income has gotten too big for its own good. That's another consequence of these big M&A deals, is that they have massively expanded the size of the portfolio of Realty Income. Up to a certain point, growing in size has benefits as it leads to economies of scale, but I fear that Realty Income has now reached a point where it's starting to suffer from these economies of scale. And to understand why this is, you need to consider that one of the main sources of growth for net lease REITs like Realty Income is property acquisitions. Typically, the annual rent escalations are quite limited. They are just around 1 to 2% per year, and so to grow faster than this, they need to raise more capital and acquire properties at a positive spread. But this also means that size can become a limiting factor because the bigger you are and the less of an impact new acquisitions are going to have on your bottom line. And so as a result, Realty Income is going to have to acquire a huge volume of assets every year, which is going to reduce its bargaining power with property sellers, it's going to reduce its flexibility, and it's also going to reduce its ability to be selective when buying new assets. And so to illustrate this point, consider that Realty Income owns about 65 billion worth of assets today, but its close peer NAREIT has a market cap of 7.5 billion, so its enterprise value is about $11 billion, so 6 times less than Realty Income. And so what this essentially means is that Realty Income has to buy 6 times as much properties just to keep the ball rolling. Naturally, that's going to make their job a lot harder, and it's going to be a disadvantage because there are only so many properties for sale at any given time. Therefore, I think that Realty Income is going to perpetually grow at a slower pace than many of its smaller peers going forward, and this is going to lead to lower total returns. The third thing that's concerning me is that Realty Income is also losing its focus. The company's first acquisition was a Taco Bell net lease property, and for most of the company's existence, it was focusing on such similar service-oriented net lease properties. It became an expert in this specific niche of commercial real estate and was very successful in it. But because of its massive size, Realty Income has now had to step out of its circle of competence and start investing in other property sectors simply because there weren't enough opportunities in the net lease market anymore. This has pushed Realty Income to invest in casinos, in vertical farming, in data centers, industrial properties, and other things as well. I view this as a red flag because you cannot expect to earn superior returns by being a jack of all trades. And for this same reason, the REIT market has typically priced specialized REITs at a premium valuation relative to diversified REITs. In a way, it has punished diversified REITs because, again, you cannot expect to earn superior returns by being a jack of all trades. And so what I fear here is that as Realty Income keeps going down this path, eventually more and more investors are going to classify it as a diversified REIT, and this is going to cause it to persistently trade at a discounted valuation multiple. This would then also increase its cost of capital and hurt its future growth prospects. Then the fourth piece of bad news that's concerning me here is that Realty Income's cost of capital is today too high to acquire additional properties at a positive spread. Its share price has crashed along with the rest of the REIT market. This is increasing its cost of equity. At the same time, as you know, interest rates have surged. This is leading to a higher interest expense for the company. And so if you go into their investor deck here, they have it all laid out for you. Their cost of equity is about 8%. And their cost of debt is about 5.3% at the moment. And so their weighted average cost of equity with a 35% LTV is about 7.1%. But the issue is that the cap rates they've been getting on their latest acquisitions is right around the same level, and so there is no spread for them to be earned. This explains why they've guided to acquire only about 2 billion worth of assets this year, down from nearly 10 billion in 2023. It also explains why they've guided to grow the FFO per share by only about 2% this year. If you adjust for the positive impact of the Spirit Realty Capital merger, this is quite a bit less than in the past. But so they're still growing thanks to their annual lease escalations, and they're also reinvesting their retained cash flow. But their growth has slowed down, and I don't see this changing anytime soon, and therefore they deserve to trade at a lower multiple than in the past. And then the fifth and final reason why I sold Realty Income, this is perhaps the most important, is that I think that it offers worse risk to reward than many of its peers. And the best example here to use is AgriRealty, ticker symbol ADC. This is a smaller version of Realty Income that, in my opinion, is not only safer, but also more rewarding. It is safer because it owns better assets, as I showed you earlier. It also has less leverage than Realty Income. It's specialized. It can be more selective about its future acquisitions, which limits risks. And it also enjoys better growth prospects, which should reduce the risk of it facing a deteriorating market sentiment in the coming years. But despite being safer, I also expect it to be more rewarding in the coming years because it's smaller in size, so new acquisitions move the needle more for them than for Realty Income. They also enjoy a lower cost of capital. They are less impacted by the surge in interest rates. They earn larger spreads on their new acquisitions, and so all of that should contribute to a faster growth rate in the coming years. But despite being safer and growing at a faster pace, both companies, Realty Income and AgriRealty, actually trade at fairly similar valuations. If you adjust for Realty Income's higher leverage, the FFO multiples are quite similar, and if you also adjust for AgriRealty's lower payout ratio, the dividend yields also aren't much different. And I would add that this is nothing new. AgriRealty has been massively outperforming Realty Income for well over a decade now, and I just don't see any reason why this would change anytime soon. On the contrary, I would think that this outperformance would accelerate going forward because Realty Income is now bigger than ever, so its size issue has never been greater, and at the same time its portfolio quality is now lower, which should increase the risk of some negative news down the line. So with that in mind, why would you favor Realty Income over a peer like AgriRealty, which in my opinion, once again, is a safer company with better growth prospects and is likely to deliver higher total returns over time? And I would add here that AgriRealty is not an isolated case. There are other examples in its peer group that are also able to generate higher returns with lower risk than Realty Income. If you're primarily investing for dividend income, then perhaps NAREIT could be a better alternative. It yields about the same amount as Realty Income today if you adjust for its lower payout ratio, and it actually has an even longer dividend growth track record. However, I would also expect it to grow faster than Realty Income going forward, which should lead to higher total returns over time. Then finally, if you're willing to take a bit more risk, then perhaps Essential Properties Realty Trust could be a better option. This is my largest net lease REIT investment today. It has consistently managed to grow at a faster pace than most of its peers because of its smaller size and its unique focus on middle market tenants. Some would argue that this is a risky approach, and this may be true, but even through the pandemic, which was the worst possible crisis for net lease REIT, it managed to keep on growing at a faster pace than most of its peers. And if you compare its returns to those of Realty Income, it's really day and night. We're not talking about a few percentage points of outperformance. The outperformance is really massive here, and so you need to ask yourself, is it worth taking a bit more risk for those significantly higher returns? I believe so. So once again, why would you invest in Realty Income if there are better options, whether you're investing for income, growth, or total returns, or even safety in the case of agri-realty? Again, I think it's a safer REIT than Realty Income. Let me know in the comment section of this video, because I really don't get it. My capital is limited, and so I need to be selective. And if you want to access my entire real money REIT portfolio, you can join High Yield Landlord, which is my REIT newsletter, for a 2-week free trial. I'll put a link to it in the description of this video. As I've said before, this is a real free trial. You won't be charged anything in the first 14 days of the subscription. You can join the service, you can check my portfolio, and then if it's not for you, you can cancel within the first 14 days and you won't be charged a penny. And then once more, could you please do me a huge favor and click the like button, and also subscribe to the channel if you don't want to miss my future updates on Realty Income and other REIT investment opportunities. Thank you so much in advance. See you at my next one. Bye bye.